Let me ask you something. Do you really think that people that win financially are the smartest one in the room? Because he is what most of people don't want to hear. Intelligence doesn't protect you to make terrible financial decisions. Actually, some of the biggest financial failures in history were extremely intelligent people. You can have a degree, understand the market, follow all the news, earn a lot of money, and still lose everything if your behavior is wrong. At the same time, there are ordinary people with no financial background at all who slowly and quietly build wealth just because they behave well with money. That is exactly what the psychology of money is about. And today I want to share 3 ideas I took from the book that completely changed the way I think about money, investing, and long-term success. Most people believe that financial success comes from knowing more than everyone else. More strategies, more indicators, more predictions about what the market will do next. But here's the truth. After a certain point, knowing more doesn't help that much. Once you understand the basics, behaviors becomes more important than intelligence. One of my friends asked me if artificial intelligence will eventually replace human in investing. And honestly, that's very possible. For sure, softwares and AI programs may manage your portfolios way better than humans could do. But even if that happens, you still need to be the one who make the most important decisions. You will decide whether to stay invested or panic, whether to add money during a crash or put everything out, and whether to trust the plan or abandon it when the fear shows up, right? No system or program can make those decisions for you because these decisions are emotional. And we know that markets doesn't destroy portfolios, but people do when they react emotionally at the wrong time. In the book, there is a real story that explains this better than any theory. It's the story of Ronald Reid, who is a man in the United States who spent most of his life working as a janitor and a gas station attendant. So no fancy job, no inheritance, no financial education. Nothing special on the paper. He lived very simply. He just bought a small house, he drove basic cars and kept his expenses low year after year. And when he passed away in his 90s, something surprising happened. People discovered that he had quietly accumulated millions of dollars. So the question is, how did he do it? Not by trading, not by trying to predict the market, and not by taking big risks. He invested consistently and stayed invested for decades and let the time do the work. He went through recessions, crashes, and moments of fears like everyone else. But he didn't panic. While others were selling, he was waiting and sometimes even buying more. His secret wasn't intelligence, it was patience. Now compare that with another story. In the same book, Morgan talks about Richard Fuscon, a highly educated financial executive who graduated from Harvard, built a successful career, earned a high income, and even appeared in major business magazines. On the surface, everything looked perfect, but his lifestyle was built on constantly growth and wealth debt. And when the 2008 financial crisis hit, that structure collapsed. So the same market that rewarded him for so long during the boom exposed how fragile his finances really were. And this comparison is so powerful because it shows something unique about investing. It feels like medicine, a janitor will never outperform like a surgeon. Engineering, a janitor will never outperform an engineer. But in investing, a calm and disciplined person can outperform professionals simply by avoiding emotional mistakes. One of the most underestimated forces in investing is time. Compound interest doesn't reward intelligence or effort. It rewards how long you stay invested. Most of Warren Buffett's wealth came later in life, not because he suddenly became smarter, but because compounding finally had enough time to work. That's why if you don't have much money today, that's not your biggest problem. The real problem is delaying the start. You don't need extraordinary returns. You need consistency and patience. Starting now beats starting perfectly. And before we dive into the second lesson, please take a moment to hit the like button and subscribe to the channel. It really helps the channel and keeps you updated with more content like this. That is a simple formula that explains why so many people will struggle financially. Saving is your income minus your ego. As people earn more money, they don't automatically save more money. Instead, they update their lifestyle. Big house, nicer cars, higher fixed costs, more pressure. And before they know it, even people who earn a lot feel like they have no money. Most purchases aren't about need. They are about status, validations, and how we want to the others see us. Wealth, on the other hand, grows quietly. Spending is loud and ego is very expensive. Imagine two people earning similar returns. One start investing early with small amounts and then simply lets their time work. The other one starts later, puts more money, and works hard for many years. The person who started earlier ends up far ahead, not because they were very smart, but because money doesn't care about effort, it cares more about time. One of the most dangerous mistakes in finance is never define what enough means. History is full of people who had more money, more power, and influence than they could ever need, and still destroyed everything because they couldn't stop. When there is no finish line, risk becomes unlimited, and unlimited risk eventually leads to disaster. True wealth isn't about always want more. It is about knowing when you already have enough. Today, many people repeat the same mistakes. They chase unrealistic returns, take risks they don't fully understand, and refuse to slow down when greed takes over. Markets don't punish ambition, but they punish lack of discipline. Financial success isn't about being the smartest person in the room. It's about controlling your behavior when emotions are at their strongest. This video changed the way you think about money. I highly recommend you read The Psychology of Money. I will leave the link in the description, and if you decide to check it out through that link, you will be also supporting the channel. If you found value in this video, don't forget to like and subscribe, and I'll see you in the next video.